Good morning, everybody. Welcome. My name is Ted Gayer. I am the Vice President and Director of Economic Studies here at the Brookings Institution. I am very pleased today to introduce today's keynote speaker, Mel Watt, who is the Director of the Federal Housing Finance Agency. We're thrilled to have Director Watt here today to give us his views on housing finance and the direction in which he is taking the FHFA. We're now approaching 6 years since Fannie Mae and Freddie Mac were placed into conservatorship. Much has changed since then, including the profitability of the companies, yet in many ways their fundamental structure is unchanged. While Congress actively debates whether and how to reform our housing finance system, the decisions that Director Watt and the FHFA make are critically important in determining credit availability for our housing market, housing affordability, and the degree that taxpayers will bear risk in the mortgage market. Director Watt has been in his current job for about 4 months now as the regulator and conservator of Fannie and Freddie and the regulator of the 12 federal home loan banks. Prior to that, he was a member of the U.S. House of Representatives for over 20 years, representing his home state of North Carolina, after serving for 2 years in the state Senate. Before that, he practiced law for over 20 years, specializing in minority business and economic development law. Director Watt served on the subcommittees on capital markets and government-sponsored enterprises and financial institutions and consumer credit on the House Financial Services Committee. Also, while in the House, he introduced anti-predatory lending legislation to combat abuses in the mortgage lending market. With that short summary, I'm going to let Director Watt take it away. Just as a note, after he speaks, he and I will have a question and answer session, and then we'll open it up to you for further questions. And then we're going to follow up with a panel of housing and consumer experts. That panel will be moderated by the Wall Street Journal's Nick Timmerose, who's, as I said, going to be the moderator. They're going to discuss the state of the housing market, Fannie and Freddie's role in it, as well as the current reforms pending in Congress. So please join me in welcoming Director Watt.
Well, good morning. Good morning. Good morning. Yeah, that's good. Let me start by thanking the folks at Brookings for hosting us and thanking Ted for his kind introduction. I do understand that a number of you have been waiting to hear from me. And that some of you have been expecting me to say some things sooner than now. After all, I was sworn in on January 6th, and except for a speech last week about the federal home loan bank system, you haven't heard a word from me. Not a peep, not a press interview, not a speech. Not a word. So some of you are probably wondering, well, has this guy made a cold turkey transition from member of Congress, outspoken, to policy wonk regulator? What's up with this guy? So I welcome you here this morning to talk for a little bit. You haven't heard much from me, but it does not mean that we have not been working. Since January, FHFA has continued to carry out its day-to-day responsibilities as the regulator of the federal home loan banks and as the conservator and regulator of Fannie Mae and Freddie Mac. Many of these decisions and responsibilities are often considered routine and may go unnoticed, but they are absolutely critical to the effective and efficient operation of the housing finance market. I can't touch on all of these responsibilities in my remarks today, but I do want to give you a summary of what FHFA has been working on since I arrived, and I hope this will provide you some insight into the direction we'll be headed in the future, particularly with reference to Fannie Mae and Freddie Mac. In addition to overseeing our day-to-day operations, my work has also involved an overall assessment of FHFA as well as Fannie and Freddie. During this time, I've witnessed the dedication and expertise of FHFA staff at all levels, as well as the tenacity and dedication of the employees of Fannie Mae and Freddie Mac, who continue to stay the course during these most difficult and uncertain times. And I would be remiss not to acknowledge and thank these staffs for their hard work. There's been a constant urgency since the financial crisis. It's been a marathon, but to these employees, it's felt like a sprint. And the people have continued to excel at every step along the way. I also want to publicly thank Ed DeMarco for his lifelong career in public service, including the time as acting director of FHFA. In the face of general great economic collapse, since the biggest one since the Great Depression, FHFA helped prevent an extremely bad situation from getting much worse. It's hard to imagine things being worse given the depth of the housing market collapse, but I very much believe that FHFA and Ed DeMarco's leadership prevented an even deeper financial collapse by stabilizing Fannie Mae and Freddie Mac. Throughout his time at FHFA, Ed was instrumental in establishing the foundation for all that we will do going forward. So, while you may notice from my comments today certain changes in focus, you should know that I firmly believe that we will be building on a very solid foundation. As part of an overall assessment of the agency, we have been very focused on the numerous policy decisions that were and are in the pipeline. In making decisions about the future strategic direction of the enterprise conservatorships, the principle we are following is how best to fulfill our current obligations under current law. This means, first and foremost, that we must ensure that Fannie and Freddie operate in a safe and sound manner. It means that we'll work to preserve and conserve Fannie and Freddie's assets. And it means that we'll work to ensure a liquid and efficient national housing finance market. Our job at FHFA is to balance these obligations, and that's a message I'll come back to throughout today's remarks. Another way of stating the principle that will be guiding us is that FHFA is focused on how we manage the present conservatorships of the enterprises and the present housing finance market under the present statutory mandates. Let me say that again. The role of FHFA is to manage Fannie and Freddie in the present under current statutory mandates. As a result, one topic that is not on FHFA's agenda, because it's not part of our statutory mandate, is housing finance reform legislation. My guess is that there are many people who expected that I would start talking about GSE reform legislation the minute I got to FHFA. I am well aware and regularly express my belief that conservatorship should never be viewed as a permanent condition or as a desirable end state, and that housing finance reform is necessary. However, Congress and the administration have the important job of deciding on housing finance reform legislation, not FHFA. Instead, our task is to continue to fulfill our statutory mandates, to execute our strategic plan, and to manage the present status of Fannie and Freddie. So today, we are releasing a new strategic plan for the conservatorships of Fannie and Freddie, along with their 2014 conservatorship scorecard. Both documents are built around three strategic goals: maintain, reduce, and build. I'd like to walk through each of these goals and discuss how they build upon and, in some cases, reformulate FHFA's past conservatorship goals. Strategic goal number 1, maintain in a safe and sound manner foreclosure prevention activities and credit availability for new and refinanced mortgages to foster liquid, efficient, competitive, and resilient national housing finance markets. Our first strategic goal, maintain, requires Fannie and Freddie to carry out and strengthen, where possible, three aspects of their core operations. First, we expect Fannie and Freddie to take actions that improve liquidity in the present single-family housing finance market. Second, we believe they should continue to improve servicing standards and foreclosure prevention actions. And third, we think they have a critical ongoing role in the multifamily sector, particularly for affordable multifamily properties. Across these three areas, our overriding objective is to ensure that there is broad liquidity in the housing finance market, and to do so in a way that is safe and sound. The maintain goal is not a new one for the agency, but we are placing an increased emphasis on it. We are leading with maintain as the first goal in our strategic plan and scorecard. We have doubled the scorecard weight to this goal from 20% to 40%. Let me begin my remarks about single-family liquidity by discussing representation and warranty standards and when these trigger repurchase demands. I know that repurchase risk remains a top concern for the mortgage industry. Lenders believe that there is still too much uncertainty in this area for them to ease their credit overlays. And ultimately, this undermines the goal of improving access to mortgage credit for credit-worthy borrowers. After extensive discussions with Fannie, Freddie, and lenders over the past several months, we are making a number of refinements to address some of these concerns. As we authorized and as Fannie and Freddie announced yesterday, they are going to relax the payment history requirement for granting representation and warranty relief by allowing 2 delinquent payments in the first 36 months after acquisition. Lenders will also get loan level confirmations when mortgages meet performance benchmark and when they pass a quality control review. The enterprises will also eliminate automatic repurchases when a loan's primary mortgage insurance is rescinded. These refinements build on FHFA's work in 2013 and demonstrate our continuing commitment to making the representation and warranty process work better for everyone. However, we know that more improvements are needed to provide additional clarity. One area we are prioritizing is addressing the scope of life of loan exemptions. We know that lenders are concerned about how these exemptions apply to loans that have passed quality control reviews or have met the 36-month benchmark, and we will work toward clarity on this issue. Over the course of this year, we will also explore the following: establishing an independent dispute resolution program when lenders believe a repurchase is unwarranted, developing cure mechanisms for loan defects rather than relying solely on repurchases, and providing additional clarity on Fannie and Freddie underwriting rules. There are 2 other issues I want to comment on that relate to the overall scope of single-family mortgages guaranteed by Fannie and Freddie. The first one involves loans with debt-to-income ratios above 43%. Current Fannie and Freddie guidelines make some of these loans eligible for purchase when the borrower has other compensating strengths. FHFA will continue to permit these compensating factors in each company's underwriting standards. As part of our ongoing safety and soundness obligations, we will, of course, continue to monitor performance data relating to these factors. The second issue involves loan limits. As market participants are already aware, FHFA released a proposal last year suggesting that the agency might use its conservatorship authority to lower the mortgage amounts eligible for guarantee by Fannie and Freddie. Many groups and individuals submitted feedback in response to the request for input, and FHFA has thoroughly reviewed and evaluated those responses. I am announcing today that FHFA will not use its authority as conservator to reduce current loan limits. This decision is motivated by concerns about how such a reduction would adversely impact the current health of the housing finance market. The next part of our maintain goal involves continuing to refine and improve servicing and foreclosure prevention standards. Experiences in recent years have revealed serious weaknesses in the servicing industry and in the foreclosure prevention alternatives offered to borrowers. Substantial work has been done to get things right, but there is still much room for improvement. As part of FHFA's focus in this area, or at least part of FHFA's focus in this area, is working to stabilize communities hardest hit by the foreclosure crisis. As a result, we are launching a neighborhood stabilization initiative with Fannie, Freddie, and the National Community Stabilization Trust. Phase 1 of this initiative is a pilot program in Detroit, Michigan. We're pursuing pre-foreclosure and post-foreclosure strategies that include deeper loan modifications and partnering with nonprofits earlier in the real estate-owned sales process. FHFA expects to use the experiences in Detroit to expand this initiative to other parts of the country. We believe this will be a win-win for hardest hit communities and for our conservatorship objectives. We've also received a number of inquiries about changing the eligibility requirements for HARP. Because the number of borrowers we could add by extending the eligibility date or by changing performance requirements is relatively small, we have decided not to alter HARP eligibility parameters. FHFA is, however, working to retarget our HARP outreach efforts to the approximately 750,000 borrowers who already qualify and would financially benefit from refinancing under HARP. We are exploring outreach efforts designed to gain the trust of these in-the-money borrowers so they will take action to refinance. It's already in their financial interest to do so. FHFA's maintained strategic goal also extends to Fannie and Freddie's multifamily loan businesses. This is a critical part of the 2014 strategic plan, particularly in light of the increasing number of households who are renting instead of owning in recent years, and the fact that that affordability continues to be a significant concern for many households. Consequently, our 2014 strategic plan does not require a reduction in Fannie and Freddie's multifamily production levels, and it provides additional capacity for affordable multifamily projects. Consistent with safety and soundness, our affordability focus will include multifamily lending for small properties and manufactured housing rental communities, much of which takes place in rural communities. We expect market competition in 2014 to actually result in lower multifamily levels for the enterprises, but FHFA will not mandate that the enterprises prematurely shrink their multifamily footprint. I'm on to the second goal. Strategic goal number 2, reduce taxpayer risk through increasing the role of private capital in the mortgage market. reduce taxpayer risk through increasing the role of private capital in the mortgage market. FHFA's second strategic goal, reduce, is focused on ways to bring additional private capital into the system in order to reduce taxpayer risk. We have reformulated this goal so that it no longer involves specific steps to contract the enterprise's market presence, which could have an adverse impact on liquidity. Instead, the reduce goal focuses on ways to scale back Fannie and Freddie's overall risk exposure. This approach allows us to meet our mandates of upholding safety and soundness and ensuring broad market liquidity. While FHFA has reformulated this strategic goal, our strategies to reduce taxpayer risk build on much of FHFA's past work in this area. This includes having Fannie and Freddie conduct additional credit risk transfers for their single-family guarantee business. These transactions have opened up private capital to share in credit losses, which protects taxpayers from bearing all of the potential losses. Our 2014 scorecard requires each enterprise to triple the amount of risk transfers in 2014. This will be an increase from $30 billion of unpaid principal balance transfers last year to approximately $90 billion in 2014. On top of increasing the amount of credit risk transferred, we also expect each enterprise to try new risk transfer structures to assess sustainability in different market conditions. All of this is consistent with the commitments I made to the Senate Banking Committee during my confirmation process. In addition, we are requiring ongoing reductions in the enterprise's retained portfolios. The senior preferred stock purchase agreements with the Treasury Department require the enterprises to reduce their portfolios to no more than $250 billion each by 2018. Fannie and Freddie must develop plans to meet this target even under adverse market conditions. We are also requiring them to prioritize selling their less liquid assets to reduce risk and take advantage of current investor interest. As their portfolios continue to decline, the effect is to transfer interest rate risk and liquidity risk from these portfolios to the private sector. On multifamily purchases, we are requiring the enterprises to continue sharing risk with the private sector, which Freddie Mac does through a capital market structure and Fannie Mae does through a risk-sharing model. Both approaches transfer significant risk to the private market and have had strong performance even through the economic crisis. We expect these models to continue. Finally, another risk reduction priority in 2014 involves private mortgage insurance counterparties. This work will strengthen master policies and eligibility standards for private mortgage insurers. Mortgage insurance is a critical source of private capital in the mortgage finance markets. However, as we all know, the crisis revealed severe weaknesses in this system. FHFA's objective is to ensure that private mortgage insurer counterparties to Fannie and Freddie are able to provide adequate credit loss protection in times of market stress. On to strategic goal number 3. Strategic goal number 3. Build a new single-family securitization infrastructure for use by the enterprises and adaptable for use by other participants in the secondary market in the future. Build a new single-family securitization infrastructure for use by the enterprises and adaptable for use by other participants in the secondary market in the future. FHFA's final strategic goal is to build a new infrastructure for the enterprise's securitization functions. The core of this effort is the common securitization platform, and I want to talk about 2 aspects of this today. First, after extensive discussion within FHFA and with the enterprises, we have clarified that the agency's top objective for the common securitization platform is to make sure that it works for the benefit of Fannie and Freddie. Over the last 4 months, we have identified the risk involved in transitioning to a common securitization platform and reviewed how to manage those risks. We found that because of the many variables involved, the main danger to the CSP effort would be pursuing too many objectives at the same time. Since any stumbles along the way could have ripple effects in the $10 trillion housing finance market, there's a lot at stake in getting this right. As a result, our decision has been to de-risk this project. Moving forward, we will focus our efforts on creating a common securitization platform that can undertake Fannie and Freddie's current securitization operations. A successful outcome will be a seamless transition from the current in-house systems that issue new securities for each enterprise to a future joint venture owned by Fannie and Freddie that operates one system with updated technology. Defining the scope in this way acknowledges that building a CSP for a future housing finance system that is not yet defined is extremely risky and could add needless cost. This scope does not mean that our CSP efforts will be at odds with the future housing finance system, or that our process will take place in a vacuum. To the contrary, we are requiring that the CSP leverage the systems, software, and standards used in the private sector whenever possible. This will ensure that the CSP will be adaptable for use by other secondary market actors including private label securities issuers, when the future state is more defined. Our second objective for the common securitization platform is to move the enterprises toward a single common security, which we believe will improve liquidity in the housing finance markets. It would also reduce costs to the enterprises, particularly Freddie Mac, since Freddie's securities have historically traded at a disadvantage compared to Fannie Mae's. Adding a common single security component to the CSP's scope will require FHFA and the enterprises to define the securities parameters along with shared contractual and disclosure requirements. FHFA, along with Fannie and Freddie, have made great progress on developing the common securitization platform. But all the components of the CSP, including the common single security, will require a multi-year effort before final implementation. Having defined the CSP's parameters as I have described today, we are well positioned to move forward. Throughout this process, we will provide opportunities for stakeholder input about our decisions along the way. In releasing FHFA's 2014 strategic plan, my goal today has been to provide a clear sense of direction for the enterprise's ongoing conservatorships. Implementing these objectives will require ongoing analysis, evaluation, and input. FHFA will proceed with these steps in a transparent way that incorporates the feedback and input of the public and stakeholder groups whenever possible. One example of this approach is our upcoming request for input on the guarantee fees charged by Fannie and Freddie, which we will release very soon. As many of you know, on my second day as director of FHFA, I issued a directive to Fannie and Freddie that they delay the G-fee increase announced in December of last year. In our request for input, we will pose a number of questions the agency is considering, and we solicit and encourage your feedback. We'll review your responses, and we'll announce a decision later this year that is consistent with the goals that we have outlined in our strategic plan. This concludes my remarks. I want to thank you for your time today, and I look forward to working with all of you as we implement our strategic plan and as Fannie and Freddie and FHFA implement the 2014 scorecard. Thank you.
Well, thank you again, Director Watt. That was a terrific speech, and there's lots in there. I feel constrained by time. I feel like we could spend hours on each of the goals.
That's right.
So we'll do our best, and then we'll take some questions from the crowd as well. So I want to start by first saying I'm going to kind of respect what you started with, which is you don't want to talk about housing finance legislation, which I can understand. But there's something you said that intrigued me right after that. You said that conservatorship should never be viewed as permanent. So I guess my question is, I think increasingly likely we might not have a housing finance legislation, or at least not for a number of years. And so then my question is, what happens to conservatorship? We're now approaching 6 years. You're saying it shouldn't be permanent. Do you have the authority to end conservatorship? And if so, what does that look like? At what point do we say, it's over, and what conditions have to be met?
Well, clearly we have the authority to end the conservatorship. It's in the statute. The statute gave us the authority to start it, and I think that it goes with that, the authority to end it, but the alternatives would not be desirable alternatives. So I think our role, and the reason we work so hard in the current space, is to make sure that we have a solid plan for continuing the operations of Fannie and Freddie and the federal home loan banks, so that there will be liquidity and efficiency in the housing market, and that we continue to operate as we have operated without interrupting housing finance in this country, because housing finance is such a critical part of the economy. To stop or stand in place just simply is not an option. So we'll continue it, and I think our goals are consistent with continuing the operation of Fannie and Freddie in the here and the now. We'll do that until there is legislation passed.
So I think maybe you've already answered this then. So the end of conservatorship, you can see the different things obviously being debated on the Hill, but two outcomes, if it's not going to be indefinite, two outcomes is one, Fannie and Freddie get wound down, and another is they essentially they exist as they currently are, as private or they become wholly private entities outside of the conservatorship. I should say wholly private because the government has a large share there. That kind of final outcome, this is at this point you don't see how the end of conservatorship looks, or do you?
Well, I haven't contemplated that. I mean, I think all of my focus for the last 4 months has been in the present and doing what we're doing in the short term, and letting the Congress run its course there, and we'll see what happens after that.
So as I said, there was a lot in your speech, but I do want to, I think, unless I missed it, there was one thing that you didn't mention, and so I don't know, I'd love to get your feelings on that, and that's principal reductions. So as I think everybody here knows, FHFA previously said that principal reductions, the potential benefit was too small relative to the known and unknown costs and risks. Is there a sense of, is this an issue that has passed? Is this something that FHFA is still considering? Where do we stand on this?
I don't know this passed. We've evaluated in the short term and found that there are other things that we need to focus on at the present. We continue to study not only that issue, but a number of other issues that I did not talk about in today's speech. I told one of the reporters earlier that it'd be interesting that all of the things that we talked about today, the focus would be on the things we didn't talk about. Yeah. So,
that's my second question.
I keep this running list of issues that I call my water hose issues. They started out coming at me as one big fire hose, and we've separated them into individual water hoses. There are a bunch of them on the list that I didn't talk about today, and principal reduction is one of those. It doesn't mean that we won't, that we are not considering it. It just means that we're not ready to talk about it at this point, and that's the same category that a lot of other issues fall into.
Okay, so let me pivot back to something that you did talk about, which were the multifamily caps. I'd like to just get your sense of the This seems to me like you started your speech by acknowledging your predecessor and also mentioning a shift in focus or maybe priorities. Does this constitute one of the shifts in focus? Not lowering the cap and giving additional flexibility? And I guess if so, what's your thinking on kind of the role that Fannie and Freddie play for affordable housing?
I haven't thought about this whole focus issue. I think we've tried to make good reasoned decisions. We've tried to understand the history of how every decision was made and why it was made. And so I'm not focusing on whether we've shifted focus or didn't shift focus. Everything that has taken place in the past has created the foundation that allows us the flexibility to make good decisions in the present. We actually think that competition in the multifamily sector will decrease the role of Fannie and Freddie in that space over time, and we think it will mean that they won't reach the caps possibly this year. The more important part of it is that there seems to be a lot less competition in the affordable space, and we want to incentivize Fannie and Freddie to continue to play that role in the affordable space because people need housing, and they have played the role successfully and with minimal risk through a very difficult time in the economy. Mm-hmm. So it's not as if we are increasing risk, but for us to arbitrarily say decrease your footprint without knowing that somebody is stepping into this space was not something that we thought was a prudent thing to do.
So in your strategic plan, you lay out a lot of kind of your statutory responsibilities, and there are many. So don't envy the task of trying to achieve all of them. One of them is that you're responsible to ensure that Fannie and Freddie maintain adequate capital. Now, of course, that's a little bit of a challenge given that all their profits now are being swept into Treasury. I'm curious what your thoughts on that. Is this something you've spoken to Treasury about, or is this just in the indefinite future going to be current policy, and how do they build their capital base?
Well, I can't control that, I don't think. The taxpayers, in effect, providing significant capital to back Fannie and Freddie at this point. So capital has not been an issue that we've had to focus on. For a period of time, obviously, it was a major issue because both Fannie and Freddie were making draws. Their financial conditions have stabilized, and while a lot of their income in the last 2 or 3 years has been big recoveries, financial recoveries, tax adjustments that won't be sustainable in the future, we want them to continue to operate in a sound way, and we're focused on that. But we don't spend time vexing about things that we really can't control. And I'm sure, I would think that Treasury would feel the same way, but I haven't had any discussions about that with them.
Okay, thank you. And so another thing you said intrigued me. I think I'm going to get the quote correct, or at least close enough. You said that your goal is to, quote, reduce tax, I think this was goal number 2, reduce taxpayer risk through increasing the role of private capital. But then right after that, you rejected the goal of contracting the enterprise's market presence. So you want to increase the role of private capital, but not contract the enterprises, which I'm trying to figure out kind of how you square those two. And maybe, and I don't, you and then said that this is a decision to come, so I know you're not going to announce it now, but in my view, you can look at an increase in the guarantees fees as either of those, as a contracting of their market presence or as an entering of private capital. How does that fit in those two criteria?
Well, we're balancing in a number of instances, sometimes what appear to be contradictory mandates. But I don't think it's FHFA's role to contract the footprint of Fannie and Freddie. Our role is to maintain an efficient credit market, and as private capital demonstrates that it will come into this market, I think it'll be clear that Fannie and Freddie will step back. But to arbitrarily say that the footprint should be reduced without assuring that there's a responsible way to make the transition to private capital stepping into the space would do serious damage potentially to the housing finance part of our economy, and I think that would be irresponsible. So we're not into doing anything that's irresponsible. I hope everybody picked that up from my comments this morning.
So just so I understand, so if the enterprise's market presence contracts due to kind of market forces and kind of a revitalized private sector, that's fine, but FHFA exactly as a regulator,
I see. Exactly what I said in the multifamily space. Okay. We didn't arbitrarily contract them, but actually we think this year the private sector will step into the multifamily space, at least in the non-affordable multifamily space, in a big way. They're already doing it, and there's no reason for us to think that they will stop. But there are some things that we could do arbitrarily that I think we're not intending to do.
Okay, I'm just getting a signal. I'm going to take questions from the crowd. I've got, if you guys need help, I've got plenty more, but I'll take questions from the crowd. How about start in the back corner? Is there a mic? Wait for the mic. So the rules of the game, please wait for the mic, state your name and affiliation, and keep it to a question.
Hi, Clea Benson with Bloomberg News. Following up a little on the discussion of the role of FHFA, how does the fact that Fannie Mae and Freddie Mac are now posting record profits factor into your thinking about how much they should be helping troubled borrowers and undertaking initiatives to stabilize the mortgage market? Is that something that's guiding some of your policy decisions now?
You know, I haven't looked a lot at profits as a driving force in any of our decisions. I think, as I've indicated already, the record level of profits that you have seen are not sustainable. It's clear that, and we've said that over and over, they made substantial tax adjustments, and they're releasing those now. And we've had substantial major recoveries in litigation that won't be repeated over time. In fact, we're nearing the end of those kinds of recoveries. So I don't think we should let profits drive decisions that we make. We're trying to make responsible decisions. We're trying to increase the availability of credit to credit-worthy borrowers. We're trying to do it in a safe and sound way and not be irresponsible. I don't think looking at the bottom line is a productive way to try to evaluate how we proceed on that front.
While we're in the back, also in the back right over here. If we can wait for the mic again.
Hi, Judy Kennedy, Affordable Housing Lenders. Thank you so much for the focus on targeted rental and small rental properties. because that's the 90% of the market that Fannie and Freddie haven't been present in. But I wanted to follow up on one thing you didn't talk about. The same law in 2008 that enabled the conservatorship also tried to focus Fannie and Freddie on affordable rental housing in a meaningful way. And that just hasn't happened, whether it's Fannie Mae trying to count the blanket loan on the Dakota property on Central Park West, the Yoko Ono property, as affordable rental housing, or other devices that they've developed. So I'd like you to speak to how you intend to change or maybe better enforce the mission-related part of Housing and Economic Recovery Act.
Well, I think the first step you just heard this morning is changing our focus to pay some more attention to it. The affordable housing goals we are looking at aggressively. They are already in place for 2014. We'll be issuing new affordable housing goals for 2015. So there's a lot of focus on that issue, and it is part of the statutory mandate and the charter mandates of both Fannie and Freddie. So we take those mandates seriously, and obviously we think that Congress took them seriously, otherwise they wouldn't have written them into the law. We're going to treat them as seriously as we treat every other aspect of Fannie and Freddie's and FHFA's statutory mandates.
Other questions? How about right here?
Director Watt, Ed Mills with FBR. I had a question about servicing. One of the issues that we hear a lot from originators about contraction of credit is not only on reps and warranties when you sell the loan, but also when you service the loan. Recently, JP Morgan CEO Jamie Dimon said he would never want to service a defaulted loan. We've seen a lot of servicing transfers come out of Fannie and Freddie over to non-bank servicers, and in recent months we've seen a lot of scrutiny on those servicers. I was wondering if you could comment on some of those transfers, what we might be able to expect in terms of regulation on those non-bank servicers, and what can be done to give originators and servicers some certainty that if the loan defaults, they're going to be able to appropriately service that product.
Well, this has been a topical and difficult issue for us because there are multiple things at play here. Jamie Dimon is right when he says it's difficult to service a defaulted mortgage. Easy to service a current mortgage because all it is collecting and remitting. But when somebody defaults, it gets to be a lot more complicated, and there is a growing industry that is built up around that. Some of whom have more expertise in this area than the lenders themselves, who tend to focus more on the lending side than on the servicing side. And Basel III has taken a lot of the capital requirements have maybe led to some of the lenders actually wanting to get out of this space. Servicers are not regulated by FHFA. They are regulated by CFPB, but not on a capital basis. So there's a shortcoming there. We can control their relationships with Fannie and Freddie, right? That's the space in which we operate, and we have looked very carefully, in some cases much longer and more carefully than a lot of people would like for us to look, at evaluating when these requests for transfers are made to see are these people responsible to whom, are the companies responsible to whom the transferring servicing rights are being transferred? What is their expertise? What is their history in this space? What kind of capital do they have if things start going bad? What kind of backup will the lender provide to take the servicing back if necessary, if the servicer doesn't? So all of those are factors, and we look at them very carefully in making our evaluations. And then sometimes there are short-term versus long-term competing considerations. Short-term, the servicer might actually do the servicing better. The longer-term concerns, you're worried about, can they sustain it over a long period of time? And we have to balance those. And I think we've been responsible in that space, and we're doing a lot of work to try to develop standards so it's clear to Fannie and Freddie what we expect when it comes to transferring servicing rights. And then they can communicate that to the lenders that they are dealing with so that they know what to expect when you're transferring. So I think you'll find that we'll be doing a lot of work going forward in that area, trying to refine what the expectations and standards are. Yeah.
I want to just piggyback a quick question off of that. On the, it's hard to write a punchy title with the phrase reps and warrants in it, but these seem like significant changes. Do you have an expectation of what impact it will have on credit overlays?
I have a hope that it will substantially reduce credit overlays, and that lenders will start operating more inside the credit box that Fannie and Freddie have said they will purchase loans in, or guarantee loans in that space. And based on conversations that we have had with industry participants, my hope is a positive hope. I don't know when you transfer from a hope to an expectation, but some of them have assured me that if we can smooth out some of these uncertainties that exist in their space, it would translate into reduction in overlays, and it would translate into more availability of credit to people who can afford to repay the loans. And that's what we are very much interested in having happen.
Like I said, we have, I'm sure both me and the crowd have a lot more questions we'd love to ask, but we are past our limit, so I just would like everybody to join me in thanking you once again for coming here today.
Good morning, everybody. My name is Nick Tamaros. I cover housing and economics for the Wall Street Journal. Pleased to get into this panel. Starting at far stage right is Phil Swagel with the University of Maryland, worked at the Treasury Department in the George W. Bush administration. Next to him, we have Mike Malloy, an executive in mortgage from Bank of America. Mike Calhoun, president of the Center for Responsible Lending and Self-Help Credit Union. And finally, Mark Fleming is chief economist of CoreLogic. I'm sure they're very familiar faces to all of you in this room. So with that, we'll go ahead and get started. I want to get the panelists' reactions to Director Watt's speech. Obviously, there was a lot of pretty interesting meat on the bone in there. And Mike Malloy, I want to ask you first what you think of the changes that were announced late yesterday on rep and warrant. Do you think those changes on representations and warranties are going to make a lender like Bank of America any more comfortable in removing credit overlays?
Well, while I wouldn't comment on the specifics of what we would do on credit, we're still reviewing those the announcements. I think it's a very positive step. The director said two things about the reps and warrants. First, he announced 3 specific items that are in the announcements yesterday from Fannie and Freddie. Those are very positive first steps here. He also announced that they're going to continue working on the things that have been issued. He mentioned particularly the life of loan exemptions, as well as dispute resolution. Those are also very important steps. So I think of it, and I think the director said, these are the first steps toward this issue, and they're continuing to work. And I think that commitment from the director is a very, very positive step in this space.
So we hear a lot, different policymakers at the Fed, the Senior Loan Officer Survey have said that credit overlays are a key contributor to tight lending standards. Would you agree or disagree with that premise right now?
Look, at Bank of America, we focus on making sustainable loans to creditworthy borrowers, and we're out there doing that in the market today. That's what we focus on, and so I think when we talk about that, that's what we're looking at. The director talked as well. Sustainable home ownership, that's where we're looking today. That's how we focus our lending, on our customers, making it sustainable for them. And so I think as we move down this path, Mark would be better to talk to the data on this than I would, but we're not. We are all out there in the market with all of our loan officers making good loans to creditworthy borrowers today, and we're going to continue doing that.
So Mark, I will ask you. I mean, some people will hear "make credit easier," and they'll hear it, coming from someone like Director Watt, who was a more liberal member of Congress, and they'll say, "Oh my gosh, this is." We're going back to the races here. This is terrible. Should we? Is that the wrong way to think about this? How do you walk through that balancing act that policymakers are facing right now?
I'll start, I guess, by saying, as an economist, I have to start with a joke on the one hand, but then on the other. We evaluate the credit box, and we have to be a little bit careful here in terms of we're looking at the loans that actually got originated. We evaluate the credit box along a number of dimensions. And so the problem is, creditworthiness is defined by, well, let's start with the simple things, the 3 C's, right? Collateral, capacity, and creditworthiness. And we look at collateral and capacity, and actually that's the DTI calculations and the LTV calculations. We're actually at or beyond what we would consider more normal. The other thing is when someone says it needs to be tighter, it needs to be looser, that there's an implied relative point, right? Relative to what? Well, if anyone says relative to 2006, run, right? Because we clearly know that it was probably too loose then, but we really have a hard time knowing. Now, what I can say is when we look across the box and sort of look at the early 2000s, that LTVs were more lax, if you will, in that dimension in LTV space. We're at about the right space. The market has really sort of moved to the CFPB definition of 43, and in fact, if you think about it, traditional underwriting practices would put a back-end ratio well below 43 even in the old days, right? So that's actually a very loose standard by historical lending practices. But it's in the credit score. That's where things are really tight. So in the early 2000s, about 12% of all purchase origination loans in any given month had credit scores of 620 or less. So a 12% share, 620 or less. Today, it's 0.3%. Now, the credit box as defined by the grid that Fannie and Freddie put out, for Fannie at least, they'll go down to 620, right? They'll lend to 620. But clearly, we're not doing very much lending at that space or even below it. And the reason really gets back to what we started with Mike is, well, if there's this uncertainty about repurchase risk, one of the best ways to avoid a repurchase is to avoid a default. And one of the best ways to avoid a default is make sure you have a creditworthy borrower. And so there's that play there that I think is the natural tension that we're all realizing is this expansion of removal of uncertainty will create more comfort to delve further down that credit curve. But we have to be careful in terms of knowing what is or isn't the right level and what's normal or not, because that's a very complex question to actually answer.
But so on capacity and collateral, we're tighter than we were even in kind of a pre-bubble era.
We evaluate it and say we're about where we were in the early 2000s.
Okay.
LTV were actually a little bit looser. If you think about it, collateral is one of the, we lost all that equity in the house price downturn. If we weren't loose in collateral space, then that credit box would be very, very tight.
Right. Mike Calhoun, same question that I posed to Mark. I mean, the people hear some of these things and they think, oh no, there we go again. FHFA wants to try to rejuice the market. I have a feeling you're going to say that's the wrong way to think about this. And so why is that the wrong way to think about this?
So for people who haven't had that much contact with Director Watt before. I think what you saw today was vintage Watt, if you will. I mean, people don't remember as much, but through his time in Congress, his first real involvement with housing was try to tighten lending standards. And for that, he was roundly criticized, ironically, for constricting credit too much. He was the first sponsor of legislation, for example, to impose predatory lending standards on some of the practices that ultimately led to the crisis. And then at the same time, he has been for broad access, but only sustainable access. He very much believes that high rates of foreclosure are a disaster for families, communities, and the overall economy. So I think one of the things that made him well suited for this job is that kind of middle-of-the-road approach that you heard here today. But I think you nailed it on. The problem right now is it's hard to make economic sense for lenders to make loans that have a substantial risk of default if there is not only the uncertainty, but in fact the practices of the GSEs to be, quite frankly, overly aggressive on buybacks. Now, they were sold lots of junk that very much correctly was put back through the crisis. So let's distinguish between those. But mortgage underwriting is challenging, and at times they have publicly taken the position that a loan file with any defect whatsoever, regardless of whether it had an impact at all on the performance of the loan, is a legal basis for them to put the loan back on the lender and force them to eat the whole cost of a default. And particularly, it's a challenge for large lenders, but it's a near impossibility for small lenders. If you're making 100 loans and you've got a risk that 3 or 4 of them can come back to you and you eat half of the loan amount, you've lost the entire profitability for that business. So I think it is an appropriate place for him to focus at the outset. I think it was one of the main bottlenecks. It's not the only one, but it was one of the main ones, and I'm very pleased to see him address that today.
And Phil, I want to bring you in here, but one of the shifts that I found interesting in this speech was, he took that build and maintain and contract framework that the FHFA had before, and preserved it, but kind of changed or toggled. The contract is now reduced. So instead of contracting the footprint, we're reducing the taxpayer risk. What do you think of that move, given that over the past 5 years we really haven't seen any kind of resurgence of private, either private mortgage-backed securities or even in the jumbo market, fairly limited to kind of the cream of the crop mortgages?
Right. So, I thought that was symbolically the most important thing he said was the change, the doubling the emphasis on maintain. And there's a sense in which the regulator was pushing the enterprises in a certain direction to get them ready for the future system. And in a variety of ways, we saw that either slow down. So, my mental image is shifting from fourth gear to first or second gear, or maybe into reverse, right, to use the car metaphor. So certainly the multifamily reverse, conforming loan limit, not reverse, but close to it. The G fees, of course, on hold. And so symbolically, that's what we're seeing, much more of an emphasis on maintain. You can even see that in the CSS, right, in the Common Securitization Platform out in Bethesda, where that's going to be for the benefit of Fannie and Freddie, which of course makes sense as a joint venture, but rather than setting the stage for a future system with competition and entry. And the second part on the resurgence of private label securitization or balance sheet lending, I think that goes very well with the credit box issue that everyone's discussed, right? Until there's the certainty on the reps and warranties, and then also on the fair housing lawsuits and the sort of state attorney generals, all the variety of factors that is inhibiting the resurgence of private lending, it's going to be tough to restart that, and it's necessary to have a better system.
Mark?
I just think, to leverage that point, one of the most interesting things about what he presented today was in that reduce or contract comment, whether you call it reduce or contract. I think we always leapt to the assumption that that meant that the GSEs would not be involved in the origination and securitization of the loan, and there would be this resurgence of private capital, right, the private label market. And he actually twisted or changed that to mean, I'm going to reduce the credit risk held by the government, but that doesn't necessarily mean that I'm still not going to participate very heavily in the production of the loan, right? You go back to the idea of the market maker on Wall Street. For every stock, there's a market maker that just makes sure that there is liquidity in that stock. We'll figure out how to buy that even when the bid-ask spreads get big. And he's really taking that approach now, which is, I'm going to reduce the credit risk held by the GSEs, but I'm not necessarily going to pull myself out of the market and allow private label capital to actually participate in the securitization investor process. And I think that's a change, maybe for the good, maybe for the better, because actually at this point, there doesn't seem to be a lot of private label or private market interest in actually participating in the old way. And even if we thought about the sheer size and scale of the market, some have suggested that there may not even be enough capital out there to do it. So I think that's a big shift that we've seen, is this concept of like the GSEs acting more like a liquidity market maker, and the goal is to reduce credit risk through these credit risk transfer type processes.
Well, and so on that point, and I want to ask you about this, Mike Calhoun, but on that point, a few years ago there was an assumption that private label would come back quickly. There was also an assumption that at some point down the road, Congress would perhaps more easily than what has proven to be the case, advance some kind of bipartisan legislation. The Senate Banking Committee looks like it's going to pass the bill, the Johnson-Crapo bill, this week, but not with enough of a majority to propel it through the Senate this year. And so if that first one is true, that we're not seeing much of a return in the private label market, we're also not seeing enough of a bipartisan consensus to push through a reform bill this year or even maybe in the next term of Congress. Where do you think that leaves the FHFA in terms of possibly advancing administratively some type of housing finance overhaul? I know Director Watt today said he wasn't really going to address legislation, but where do you think he could take this if Congress chooses not to act?
Well, I think, first of all, in his remarks today were a little prescient in that, as you said, the vote is coming up on GSE reform, but it looks like that's going to be a longer process rather than shorter. And I think that's just part of the landscape, and he's saying my job is not to tilt that landscape, but to provide a stable housing system while Congress sorts it out. He is a creature of Congress from more than 2 decades, and I think he has great deference to the role of Congress to make those policy decisions rather than himself. I think it also recognizes, though, 2 things. One, the public role in housing finance has been large even through the peak of the PLS private label securities. People think that while it's at abnormally high levels now, it has, even through normal market cycles, been how most people get their home mortgages. Private label securities, even at their peak, were not dominant in the market compared to the role that government played in providing that just foundation that our system operates under. And then furthermore, as people have alluded to with the tightness of the credit market right now, the credit market is not just affecting some home buyers. It's affecting the broad economic recovery here and holding it back as housing starts are still very much depressed compared to normal levels, not compared to the boom years of the mid-2000s. And credit is most constricted for those first-time home buyers who would be buying those starter homes, but are also essential to making the whole pipeline of the housing finance system work. If they're not those new first-time home buyers, people moving up or people trying to retire don't have a good market to sell their houses into, and it impacts the whole economy. So I think his approach is spot on in terms of what is the role of FHFA and what is needed right now in the housing economy and our overall economy.
Mike Mulley, I want to ask you about Johnson-Crapo, because the conceit behind Johnson-Crapo is we will replace many of the functions currently performed by Fannie and Freddie with new privately capitalized either guarantors or this kind of securities execution. Some folks have suggested maybe you could get to the same place simply by restructuring Fannie and Freddie as a seller servicer to the GSEs. How do you think about the benefits or disadvantages of one over the other?
Well, I think trying to predict the end state or what Congress might do is a very difficult game. And so, I think instead of looking at, what might an end state be here versus there, I think you have to move back to sort of the base principles. And the base principles the director talked about, base principles of Johnson-Crapo, of, getting private capital back into the market in the first loss position ahead of the taxpayer, right? I think that sort of first principle is critical. And then saying, how do we deal with the risk of, catastrophic risk beyond that, right? Is another principle that you have to say, okay, how does the government play there? What is that role? How does that role play itself out? I think those are the items that, back to what the director is doing, back to Johnson-Crapo, what they were trying to do, back to any of the things, rather than what is one end state or the other, you have to move back to those principles and say, are we moving? Are we talking about the right principles? And that's where I think the debate has gone. But I think that concept of private capital coming back in is critical, and that and so I think looking for what are the solutions that look like that.
Yeah, Phil, I mean, you were involved initially, I know, in some of the discussions around the Corker-Warner bill. If that idea has kind of reached its maximum level of support, is it worthwhile to say, all right, well, let's look at how we can do this utilizing the GSEs, or are there reasons why you don't want to go down that road?
No, I think that is the natural next step. I would say the next step really is to let the firms build capital. And so Jim Milstein, who's here, and I have an op-ed together in the Washington Post from like a year and a half ago, just making sure he doesn't leave. So we have an op-ed from December 20. Exactly. We have an op-ed from December 2012, which said, look, the firms should build capital. That's what insurance companies do. They build capital, they pay claims, and they're not able to do it now. So, all the other questions about the Third Amendment aside, the firms should be building capital. They're profitable. Jim and I said the profit sweep doesn't make sense. But look ahead. How does the system evolve? Right. So hopefully more capital, both internally and through the credit-linked notes. Going from 30 to 90 is triple, but it's 90 is very close to zero on a $5 trillion balance sheet. So that seemed like a pretty modest step taken today when the risk transfer transactions are so successful so far. But more private capital, the two firms will continue to be regulated, and the retained portfolios, the internal hedge funds, will wind down. That's not as far a reform as Johnson-Crapo, but it is it's much better than the system before the financial crisis. That's for sure.
So do we need Congress to do legislation, or could FHFA, how much of this could FHFA advance unilaterally, administratively?
Yes, I mean, a lot of what I just said, FHFA could do. I mean, again, that's why the 90 billion number today was so disappointing. It really is downshifting to first gear, or maybe second gear or something. But the rest they could do. I mean, the worry I have still is the competition, right? That was the too big to fail in competition, right? If there's going to be two firms, they have market power, and of course in the old system, they use their market power, right? In the same way that Amazon today is using its market power against publishers, as we all read a couple days ago. That's the concern. Can a regulator get at that? I don't know.
But there's also, there have been great benefits to what the GSEs have done, market power and concentration of involvement and concentration of risk, honestly, to the taxpayer or to the government aside. The GSEs have created a very liquid and amazingly efficient and standardized market. You contrast the GSE world of the two securities and DU and LP and how a loan is done in the old days versus the wild, wild west of the private label capital markets, and we kind of see what happened, right?
Yeah, no, for sure. We want to keep the good and address the bad. So the good is exactly that. The bad is the use of market power, the 50 basis points skimmed off from $5 trillion for shareholders and management. That's the part we want to address. That's why I worry about if we go back to the old system, we'll go back to the slush fund days and all that. And I don't think so. Look, we've got a good regulator, but that's the concern.
Well, so I want to ask the panel then, and anybody can jump in here. How do you deal then with the ownership structure of whatever this new or reformed model looks like. And I want to read a quote from, this is from Dan Mudd, who was the former CEO of Fannie Mae before it was taken through conservatorship. And when he testified before the Financial Crisis Inquiry Commission, he said that by 2006, Fannie Mae was engaged in a continual struggle to balance all the requirements of public mission, all the duties owed to shareholders. Fannie was required to expand lending, conserve capital, provide liquidity, meet housing goals for the underserved, serve shareholders and homeowners alike. Perhaps we should have gone to the government and gotten a clear answer to the question, do you want more capital, more lending? He said, there are subjects where I respectfully differ with former Treasury Secretary Paulson, but I do agree with his ultimate assessment that the cause of the GSE's troubles lies with their business model. A monoline GSE structure asked to perform multiple tasks cannot withstand a multi-year 30% home price decline on a national scale, even without the accompanying global turmoil. And so he went on to talk about the horrible choices that the company faced in 2006. How do you, to the extent, hopefully we're never in a situation, of course, like 2006 again, but if we are in that environment where there's been a lot of pro-cyclical lending and you have an entity that's supposed to be counter-cyclical, how is there a way you can address the ownership structure to remove some of those pressures from somebody in that position?
I'll jump in and say yes in a couple regards. First of all, it's sort of back to the future. I mean, Freddie started as a mutual. You could send the structure back to that. That's what's used by the Federal Home Loan Banks, where they're mutually owned by all the participating lenders. So you remove that conflict of maximizing shareholder return. And quite frankly, I think it's important to realize how much reform has already been implemented. Not just at the GSEs with more transparency, with a fully empowered regulator, but what really was the core of the problem, and that was the unsustainable mortgages that brought down the housing finance system. And there, the reforms of full documentation, of determining ability to repay, of discouraging the riskiest features on loans. If you take just QM loans, for example, just the product features, you would have reduced the default rate through the crisis with the 2000-2008 book of business to a little over 5%, which the system would have readily handled. That's not even putting in the debt-to-income limit. And so by making loans more predictable and safer, it is fundamentally a better system. There's still risks there that need to be addressed. But we securitize subprime car loans. We securitize credit cards. We had more transparency. The problem was we had lack of transparency in that market where investors did not know what they were buying and did not get what they thought they were buying, and you had volatility that you could not match. Our markets are actually quite good at pricing and managing risk when it's transparent and when the volatility is predictable.
I would actually tweak that comment a little bit. It's not necessarily that they didn't know, although there was a limited amount of availability of information, and transparency and transfer of information, symmetric information is very important and good. But I think there was also this grand, and we'll use Dr. Watt's statement, expectation. There was one clear expectation that house prices would always go up. So I didn't really care what I bought, right? And that was ultimately, obviously, a big mistake. But it's the one thing that really explains all this behavior. Give someone with poor credit a high LTV, low, no-doc loan with all the funky features. We'll call them financial innovation to be nice here, right? And say that's okay because the value of the asset backing it today will be worth more tomorrow than it was today, and so I'm good. And we sort of learned. We never expected. There's a famous Lehman Brothers prospectus on a bond. And in the back of the bond, they go through the details of their house price simulations, and they say, well, there's this one possible path of prices going down by 3 to 4% negative. And they show that if that happened, basically most of the tranches of that bond would get wiped out because it was a really terrible subprime pool of loans. And then they assigned a probability of, say, 1 or less than 1% to that likelihood happening. So we're all good, right? And, so you get back to these conversations like the black swan conversation. We had what we now know, once you have a black swan, it sort of becomes white because it's now known. And so what's the next black swan? Is it a 60% decline in house prices or something else that we'll do to ourselves on the 7-year cycle?
Interest rate shock.
Interest rate shock, yeah, something like that. But So, we have to, we sort of look at these things and say, we should own collectively, the mortgage industry, the consumer, everybody, we should own this problem ourselves because we all had a role to play. We made bad decisions around our expectations. We won't make that mistake again, but as all of us sitting in this room definitely know, I'm sure we'll make another mistake again.
And on that sobering note, I'll.
I don't want to end it. Come on, ask one more quick question.
No, I want to see if the audience has any questions. If you do, please state your name and ask a question. Yes, in the back.
Hi, Phil Wallach from Brookings. I'm just wondering, the private shareholders have gone entirely unmentioned up to this point. And obviously they're bringing cases in various courts trying to assert that the Third Amendments are illegal, and we don't know how congressional action might affect them, but I was just wanting to throw that out there, see if any of the panelists want to comment on what's the likely fate of those lawsuits and of the private shareholders.
Any lawyers up here? Phil?
Look, I don't know. That's up to the courts. The government has effectively told the firms, shareholders, you still own your car, but you never get to drive it again. We, the government, get to drive it forever in the future. I don't see how that's legal, at least in English instead of Russian. Look, we saw in the auto bankruptcies that it's tough for a federal judge to go against the government in this situation. So we'll have to see how that goes. Again, I think it's just bad policy. So forget the legal part. It was bad policy. The Third Amendment was not necessary, right? The ostensible reason for putting it on to avoid the 100 billion caps didn't make sense at the time. It doesn't make sense today. It'd be better as a policy matter for the firms to build capital.
Was it a mistake to not take 100% of Fannie and Freddie, given that the taxpayers had all of the downside? People cite that 188 billion number as if that was the maximum the U.S. had agreed to inject, when, of course, the truth is that the U.S. was willing to put in $400, $500 billion. 188 billion isn't really where the clock stops.
Right. So I have a paper that was written for a conference here at Brookings in April 2009 that goes through in more detail. So you Google Swagel financial crisis, you'll get many things, but that's one of them. Some of my fans are there too. But right, the structure of the PSPAs was put in place to avoid having the assets and the liabilities coming onto the government balance sheet at that time. And I think no one envisioned that in some sense, the administration would take so long to move forward on housing finance reform. The support for the government, as Nick said, was unlimited. Right? There's a payment in kind provision, as usual in the stock agreements, and so the government could have put in an unlimited amount at a 12% rate rather than a 10% rate. So again, for many reasons, the Third Amendment is baffling. But again, I start with his poor policy.
Any other questions from the audience? Yes, Rob.
Thank you. Rob Zimmer, Community Mortgage Lenders of America. The co-op idea is interesting to me, but representing mortgage bankers which are relatively thinly capitalized. They don't have deposit insurance, don't have the Fed window, didn't get TARP money, they have their warehouse lines. And so help me think this through. How would that work? Could the mortgage bankers, would they be required to inject equity into the new entity? They're not members of the home loan banks, partly for the same reason. How can we make sure that the future system still serves mortgage bankers appropriately, so non-depositories in general?
I'll ask you, Mike.
Sure. I think those bankers are a critical part of the system, so they need to be served in any successful reform here. And I think there are a couple ways. One, of course, is the cash window. It's one of the things that the current GSEs provide that is very popular with small lenders in general. There are also correspondent arrangements that mortgage bankers could do that would feed into the mutual structure. But both of those, I think, are ways to address it. But in any event, I would agree with you totally. It's critical that they be addressed. And one concern we have about some of the possible reforms is the mortgage market has concentrated more post-crisis. And we think that is an unfortunate trend and that we want more competition among mortgage originators. I think it's good to step back. Everyone in the room here is deep in all the intricacies. But all this is pretty much a black box for the average home buyer, home seller. They want to be able to get a mortgage at a good rate. They want credit to be there through the cycle. And I think we really need to think about how that interface works. We need to make sure the back room, if you will, of it is stable and sound and responsible, but ultimately it needs to serve the customers on the street.
And with that utility, or I guess the kind of co-op model, would you envision there being just one? Would you have multiple, secondary market guarantors, or do you really only need just one?
There'd be various options there of their different functions of the aggregating of the loans to bring them together for the pooling, and then the guarantee. I think there is a consensus on a lot of things about GSE reform, that we want more private capital, so I think any system will have more private capital in front of it. There'll be deeper insurance, more capital required by the guarantors. People differ about exactly where to set that, but at far, far higher levels. I mean, people are talking about near multiples of 10 times as much capital as what was there before. And you could do that various ways. So you could combine the aggregator and the guarantor in the co-op model, or you could have multiple guarantors. I think all these systems envision a continuization of the private mortgage insurance companies with, as Director Watt referred to, greater scrutiny as to their capitalization and their operation to make sure that they are there, in fact, in a crisis.
Phil?
Right. So I would just, say I'm going to disagree here, but it's not. Different people can disagree on this stuff. I look at the co-op model and say it has a number of problems. It doesn't get at the too big to fail problem. If anything, it enshrines it. I think ultimately it'll turn in. So I think a synonym for co-op is Wells Fargo, J.P. Morgan joint venture. Right. I think those are synonymous terms. And I just don't. I don't think is what we need for the system. I would say failure should be catastrophic, right? If there's another failure of the system, the officers should be fired, the shareholders should go to zero or nearly to zero, and so on. And with co-op, you can't have that, right? It has to stay in there. So my criticism is actually from the left, which I know is going to be ironic, that if the future, if someone says we should have a co-op, I would say no, don't stop there. Have a single utility. Run it by the government, call it what it is, and don't have a co-op. So that's my disagreement.
We'll have time for one more question. Yes, straight in the back here.
Chuck Gabriel at Capital Alpha.
Here's the mic.
Yes, thank you. Chuck Gabriel at Capital Alpha. Just a question maybe for Mike with regard to the Fannie Freddie rep and warrant language that was released yesterday. A lot of us didn't have a chance to peruse that very closely. There had been a lot of ideas out there, for instance, in moving to a narrower sunset window on loans going forward. This didn't seem to go there. I was just wondering, how the notion of allowing up to 2 delinquent payments in a 36-month period and the other changes that the director mentioned, how far did that go towards satisfying the issue, or do you think they might actually consider additional changes going forward?
Right. Well, and that's what I was getting at with my first comment, which is these are a very important first step, very positive. And when you do study them, there's also, in addition to the payment issue, there's some requirements around if a QC review is done, then there's can't be a subsequent repurchase demand. Also, the rescission of mortgage insurance doesn't result in an automatic repurchase, and those are significant steps. But what I believe is equally important, perhaps even more important than those positive steps, is the fact that the director said they are committed to working on these things. And we haven't yet seen the strategic plan, but I have the impression that some of those items that he was mentioned from the podium today will be in the strategic plan to keep working on those items. And so I think, like many things, it's an iterative process, but the director making it such a point in his speech and talking about the commitment to keep working on it, I think is as important as what words are on the page in the announcements yesterday.
If I can add, I think the two key components are ultimately going to be materiality. There's a requirement that you show that some defect had some causation with the mortgage actually defaulting, which today there is astonishingly no requirement of that. And then to add to that, you have that the GSEs currently unilaterally essentially get to decide, do you have to buy back? I mean, people can fight it, but they're the ultimate deciders on that, and some dispute resolution system for that. But right now, it's got a long ways to go to be in a good place. I would certainly agree with that part of your comment.
This is not something just that the secondary market, the GSEs, or even the private label market, whatever there is in terms of repurchase rep and warrants has to do with these, is that the mortgage industry itself, I think, bears some responsibility in doing a better job of manufacturing the loans in the first place, right? You know the lemon laws for cars. Well, if you think in the mortgage industry, in many instances, it's like we roll lots of cars off that production line, missing lug nuts and on wheels, and sometimes the whole steering wheel, and that's not acceptable from the car making perspective, and it shouldn't be acceptable from the mortgage industry's perspective. And we're doing a lot, even the GSEs are doing a lot to try and ensure that the information that is important and material to the credit risk on a loan is correctly captured and documented and put in the loan files and originated through the process. And that's that will in many ways help with the repurchase issue along the way with the concept of materiality. We know the information up front. If it's bad going in, the loan won't get originated. That information will usually get fixed and provided appropriately, talking about credit scores, LTVs, DTIs, the important attributes, such that the risk of repurchase will be much lower because of the improvement in the manufacturing process itself.
Great. I think we're going to leave it at that. Thank you all very much for attending, and we'll see you at the next one.